Welcome to The Explainer. Today, we're diving into one of the most wild events we've seen lately in the financial markets. We are going to look at exactly how market mechanics, heavy leverage, and automated systems absolutely collided to create a total disaster for one single trader. Let's get right into the data and see what happens when modern markets are pushed to the absolute limit.
Okay, just look at that number, $24 million. Imagine spending weeks carefully building up a market position, meticulously placing your bets that an asset's price is going to tank. And then, bam, the market suddenly whipsaws against you. In basically 12 seconds, a staggering $24 million practically vanishes into thin air. I mean, this wasn't a slow, painful bleed. This was a sudden, violent evaporation of wealth. So how on earth does a fortune that massive just disappear in the time it takes you to pour a cup of coffee?
Let's jump into Section 1, the 12-second disaster. So our story centers around a specific wallet over on the Hyperliquid exchange, famously known on-chain as pension-USDT.ETH. Based on reporting by CoinDesk, this trader was holding an absolutely massive 50,000 Ethereum short position. And this position didn't just slowly lose money over time. No, it was forcibly liquidated. But here's the wild part. The forced buying required to actually close out that huge position ended up pushing the entire market even higher. And as you'll see, that made the liquidation more and more expensive with every passing second.
Which brings us to Section 2, a highly profitable trader. You know, when a giant account blows up like this, it's so easy to just assume the trader was some reckless rookie. But the blockchain data reveals a pretty ironic twist. This specific wallet had actually been shorting crypto for about 2 months, raking in roughly $49 million in profits. I mean, their strategy was completely working. But then in literally 12 seconds, nearly half of those hard-earned profits were completely wiped out by a single $24 million mistake. And that perfectly highlights a really crucial lesson for us. A high win rate doesn't protect you from position sizing risk. When you're right over and over again, it's so easy to fall into this dangerous psychological trap. All that past success basically encourages you to take on dangerously large positions. You start feeling invincible, right? So you size up, leaving yourself with absolutely zero margin for error.
Let's break down exactly how this happened in Section 3, Mechanics of the Bet.
Now, just to quickly recap the context here, when this trader was building up that massive position, Ethereum was trading right around the $1,900 mark. They were betting really heavily that the price was going to drop from there. Obviously, a short position profits if the price falls. But if the market suddenly flips and starts climbing, well, you expose yourself to immense downside risk. And the sheer scale of the exposure we're talking about is just staggering. 50,000 ETH is a colossal amount. Depending on the exact price at the time, their notional exposure was sitting at roughly $100 million. But because of leverage, the trader only had to deposit a fraction of that amount as collateral. And this is the double-edged sword, right? Leverage absolutely magnifies your gains, sure, but it equally magnifies your potential ruin because your actual underlying collateral is tiny compared to the massive bet you're making. Since your collateral is only a fraction of that total trade, the exchange simply cannot let your position bleed out forever. If Ethereum starts rising and eats through your collateral, the exchange's automated risk engine takes the wheel. It doesn't call you to check in, it doesn't wait to see if the market will turn back around, it steps in and forcibly liquidates your trade to make sure your account balance doesn't dip below zero.
And that automated trigger is what led to Section 4, the liquidation feedback loop.
That automated closure is exactly what kicked off our main event. According to CoinDesk's on-chain analysis, this monstrous short position wasn't just cleanly closed out in one simple transaction. Instead, it was violently unwound across 5 forced sales, taking a total of just 12 seconds. I mean, injecting an order to buy 50,000 Ethereum into a market that's already moving incredibly fast, that is absolutely guaranteed to cause some severe turbulence.
It created this completely vicious feedback loop. Step 1, Ethereum's price ticks up. Step 2, the short position loses money, which triggers the liquidation. Step 3, the exchange steps in and forces the trader to buy Ethereum to close that short. And Step 4, all that massive forced buying actually shoves Ethereum's price up roughly $43 higher, which means suddenly the next chunk of the short that has to be closed becomes even more expensive to buy back. It just feeds on itself.
The loop got so incredibly aggressive that the final chunk of the trade couldn't even be closed out normally on the open market. The last 1,417 Ethereum actually had to be absorbed directly by Hyperliquid's insurance fund. Leveraged exchanges have to have these robust risk management architectures in place specifically to handle positions where the losses blow past what the open market can safely absorb without triggering a total systemic meltdown. It's a pretty fascinating safety net, and it literally had to catch a falling knife right here.
Let's zoom out a bit for Section 5, Lessons for the Market. First off, and we need to be strictly impartial here, one massive liquidation event like this does not prove we're in an Ethereum bull market. It doesn't prove that ETH is guaranteed to just keep rising, and it definitely doesn't mean short sellers are universally wrong in their broader analysis. Look, mechanical liquidations are just the mathematical consequences of heavy leverage positioning. They tell us a whole lot about market structure and crowded trades, but they don't automatically predict where prices are going next.
If you want to spot these kinds of crazy liquidation cascades before they happen, market structure really boils down to 5 key metrics you should watch: the underlying asset price, open interest, which shows you total leverage in the system, funding rates, clusters of liquidation levels that act kind of like price magnets, and overall market liquidity. When leverage gets way too crowded on one side of the boat, a tiny spark in any of these metrics can easily ignite a massive fire.
As we wrap up this explainer, it's really vital to separate the cold hard facts from our own assumptions. We firmly know the details of the 50K ETH short. We know about the $24 million loss, and we know about that wild 12-second timeline. But what don't we know? We don't know this trader's full portfolio. We have no idea if they had long positions somewhere else acting as a hedge. So we really shouldn't pretend that this one single wallet represents their entire overall market view. Sophisticated traders use very complex, multi-layered strategies.
But I think the final verdict really boils down to this one idea. In leveraged markets, survival can often matter a lot more than actually being right. You can have the absolute best macro thesis in the world and a proven history of multi-million-dollar profits, but leverage makes being wrong, even for just a few seconds, vastly more expensive. Your fundamental analysis simply doesn't matter if your position sizing forces an automated engine to wipe you out before your thesis even has time to play out. So I want to leave you with one final lingering thought. Because this crazy event, it didn't just happen in a vacuum. It happened across a much broader market landscape. The real question we should be asking isn't just who lost the $24 million, it's how many other massive, highly leveraged positions might be sitting just above the next major price level, completely exposed to this exact same 12-second feedback loop. Seriously, who is still short out there? Keep your eyes on the data, and we will see you in the next explainer.